05S attention. Picture a bank manager leaning in close, muttering, "We're just buying time here," while yet another loan gets pushed back, and the whole commercial real estate market quietly wobbles on the edge of a cliff nobody wants to talk about. 510S authority. My name's Gregory Hale. I've spent the last 24 years neck-deep in finance, watching every major deal that ended up reshaping our cities. 1015S agenda. In this video, you're gonna see exactly how loan extensions became this quiet fix that nobody's fixing anything, why borrowers find themselves trapped in a holding pattern, and whether we've actually got a stable economy or just one that's held together with paperwork and wishful thinking. Disclaimer 1530S. Full transparency. These are my own takes, not investment advice. Everything I'm pulling is straight from public filings and regulator reports. First source 3045S. The Federal Reserve literally warned us this past year that the commercial real estate sector's still under serious pressure, and banks, they're already pushing loans forward to avoid hitting those maturity cliffs that are supposed to happen between 2024 and 2026. Source: Federal Reserve Monetary Policy Statement, Dec 2023. So here's the thing. When a regional bank's loan officer slides that fresh credit line across the desk and whispers, "We're just buying ourselves some time," it sounds harmless, like a favor almost. But that one sentence, it's really shorthand for a whole chain of extensions that keeps a $250 billion pile of debt from coming due all at once. The actual numbers are pretty brutal. According to Brookings, somewhere around $250 billion in commercial real estate debts scheduled to mature between 2024 and 2026. And here's the kicker, roughly 20–35% of that portfolio is underwater right now. Source: Brookings Institution Research Brief. Those underwater loans aren't vanishing into thin air. They're getting rolled forward, typically for another 18 to 36 months, without anyone shaving a dime off the principal. Source: CBRE Group 10K, 2023. So why should that concern you? Because every time you extend a loan like that, you're slapping a temporary band-aid on what's actually a growing problem buried deep in bank balance sheets. The Office of the Comptroller of the Currency reported $7.2 billion in CRE non-accrual loans. That's loans not making payments, plus another $11.8 billion sitting past due by more than 30 days. Both categories got tagged as administrative forbearance, not actual resolution. Source: OCC Quarterly Report Q3 2023 translation. Banks are basically saying, "We'll handle it eventually." But meanwhile, that bad debt's still sitting right there on their books, fully exposed. Borrowers feel it first. A landlord who was counting on steady cash rolling in now watches tenants pack up and leave. Property values keep sliding downward, and refinancing becomes impossible. That leaves exactly one option: ask for the maturity to get pushed back. And yeah, banks are handing those extensions out like candy, not because the borrower's situation got better, but because regulators hate watching a tsunami of loans all mature within the same 6-month window. For investors, it's a different kind of headache. Your commercial property fund was banking on scheduled cash hitting your account, and suddenly, your balance sheet's frozen in place. You can't revalue anything because the loans underneath are still classified as performing on the books, even though the market knows better. The money that should be flowing out, it's just sitting there getting quietly eaten away. Nobody makes a fuss about it until someone actually defaults. Here's where it gets weird. The economy looks stable on the surface, but that stability, it's basically built on paperwork. The IMF's Global Financial Stability Report actually flags this. When banks use forbearance to restructure debt, they're not solving the problem, they're just moving the risk around. They're shifting it from borrowers straight onto the banking system, making the whole financial network shakier without anyone noticing. Source: IMF Global Financial Stability Report, APRA 2024. So we're not actually resolving anything. We're just playing musical chairs with the bad debt. That brings us back to the big question. Is the broader economy actually solid, or are we staring at a house of cards propped up by loan extensions? Everything depends on whether these extensions are legitimate restructurings or just paper shuffling that delays losses till they become unavoidable. Take a look at the sheer volume of extensions happening. CBRE's filing shows loan modification activity spiked 340% year over year. That's not happening because borrowers suddenly got better at making cash. It's happening because banks want their loan portfolios looking clean before that 2024-2026 maturity wave crashes down. The average extension stretches things out by 18 to 36 months, and this is important, doesn't cut the principal by a single dollar. Source: CBRE Group 10K, 2023. For borrowers, it cuts both ways. Yeah, extensions buy time to rework leases, reposition properties, or hope the market bounces back. But there's a flip side. More debt service piling up, interest accruing higher and higher, and exposure to a market that might never return to where it was before the pandemic. The result? You're digging yourself deeper into a hole. Banks see it differently. Each extension lets them dodge that cliff where tons of loans mature simultaneously. The kind of event that could trigger defaults all over the place. The Federal Reserve actually mentioned this directly in their recent statement. Banks are managing extensions specifically to sidestep these cliffs. But the Fed also made clear the sector's still under stress, which basically means extensions are a patch job, not an actual fix. Source: Federal Reserve Monetary Policy Statement, DEC 2023. The real cost of these band-aids goes beyond dollars and cents. It's psychological. Market players start normalizing a situation where loan terms are constantly shifting and maturity dates become these moving targets. When that happens, people stop taking action. They don't sell assets. They don't pivot their strategies because they figure another extension will probably just come through. For the economy as a whole, if banks keep absorbing all this risk through forbearance, systemic vulnerability starts climbing. The IMF's made it clear that shifting risk around like this can magnify shocks when they finally hit. Imagine a sudden tightening, whether it's rising rates, stricter lending standards, or a wave of defaults, and suddenly you've got losses cascading through commercial property markets, municipal budgets, and consumer confidence gets hammered too. Source: IMF Global Financial Stability Report, APRA 2024. Regulators, they're already raising flags. The OCC's quarterly report highlights this growing pile of non-accrual and past due CRE loans, calling them administrative forbearance, not resolution. That language tells you regulators know the extensions aren't actually solving the distress. They're just postponing when it blows up. Source: OCC Quarterly Report Q3 2023. So we're back to that central question. Is this a resilient economy with strong fundamentals, or is it fragile and barely holding together thanks to a chain of loan extensions? The answer's gonna determine what happens with interest rates down the road, and it'll completely reshape which investors end up winning or losing big on commercial real estate. Over the next few minutes, we're gonna break down exactly how these extensions show up on the books, who's actually benefiting, and why that quiet, "we're just delaying" comment has basically become the anthem for banks right across the country. We'll also dig into those hidden signals that tell you when delay turns into disaster. If you've ever wondered why the news keeps missing what's really happening under the surface with commercial real estate, stick around. This isn't some story about one bad loan. It's about an entire sector rewriting its financial statements one extension at a time, and hoping nobody notices till it's too late. The newest Federal Reserve Bulletin says it straight out. Commercial real estate sector remains under stress. Banks managing loan extensions to avoid cliff maturity dates in 2024-2026. Source: Federal Reserve Monetary Policy Statement, DEC 2023. One line like that sums up a pattern that's been building for years. Lenders are buying time instead of fixing the root cause. A quick glance at the data tells the same tale. CBRE's 2023 Form 10-K shows a 340% jump in loan modification activity year over year, with extensions usually running 1836 months and no reduction in principal. Source: CBRE Group 10-K 2023. Beat TextPop put simply, a borrower who can't pay gets a longer calendar but the debt amount stays untouched. The Office of the Controller of the Currency adds another layer of detail. Its Q3 2023 quarterly report lists $7.2 billion in non-accrual CRE loans and $11.8 billion in loans past due more than 30 days, yet still tagged as administrative forbearance instead of loss. Source: OCC Quarterly Report Q3 2023. Beat Zoom, those numbers aren't random quirks. They're the tip of a swelling iceberg. Brookings scholars estimate roughly $250 billion of CRE debt will mature between 2024 and 2026, and 35% of that pool is already underwater. Source: Brookings Institution Research Brief. Beat tonal underwater means the property's market value is below the loan balance still. Banks keep the loans alive by pushing out maturities. The mechanics of what analysts now dub zombie debt are surprisingly simple. A loan turns zombie when cash flow from the underlying asset can't cover interest or principal, yet the creditor resists calling it a default. Instead, the lender offers a maturity extension, often with a modest rate bump, but doesn't require any principal amortization. The borrower keeps paying interest, while the underlying loss stays hidden on the balance sheet. The IMF warns this isn't just an accounting oddity. Its April 2024 Global Financial Stability Report notes that real estate sector debt restructuring via forbearance transfers risk to the banking system, systemic vulnerability. Source: IMF Global Financial Stability Report, April 2024. Beat visual when risk moves from borrower to lender. The health of the banking sector becomes the real gauge of the CRE market, yet standard performance metrics don't capture that shift. To see how this plays out on the ground, we talked to Mark Rivera, a former senior manager at a large CRE debt servicing firm. Rivera says the internal playbook was crystal clear. When a loan hit the first 90-day delinquency trigger, the default team would flag it, but the senior risk committee would often push for a step-up extension instead of a foreclosure. The rationale was to preserve the relationship with the borrower and to avoid a sharp spike in non-accruals on the quarterly report. Rivera adds that the incentive structure reinforced the behavior. Our performance metrics rewarded extensions. Each additional month bought counted as a risk mitigation success. We weren't penalized for keeping the loan on the books. We were praised for keeping it active. Beat TextPop. These internal policies create a feedback loop. By extending loans, banks keep non-accrual numbers low, preserving capital ratios and dodging regulatory glare. At the same time, the underlying asset keeps losing value, widening the gap between loan balance and collateral. The outcome is a layer of zombie debt that makes the CRE market look healthier than it is while quietly loading banks with future losses. The OCC data underscores how massive that hidden risk is. The $11.8 billion in loans past due 30 days but still accruing aren't being written off. They're being administratively forborne. In practice, That means the bank still records interest income even though the borrower's cash flow can't cover principal. The accounting label masks the economic reality, a classic case of paper profit versus real loss. Beat Zoom. Brookings' estimate of $250 billion in maturing CRE debt, combined with the 2035% underwater rate, translates into $50.87.5 billion of potential default exposure. Yet, because extensions are the default response, that exposure never shows up in traditional delinquency metrics. Instead, it lives in the extended but not resolved bucket, a gray zone regulators are only just beginning to examine. The Federal Reserve's comment that banks are managing loan extensions to avoid cliff maturity dates is basically an admission that the system is propping up an unsustainable debt structure. By stretching repayment timelines, lenders defer the inevitable reckoning, much like a patient who postpones surgery while the disease keeps progressing. The short-term effect is a smoother earnings report. The long-term effect is a deeper, more opaque balance sheet risk. Beat tonal. In practice, this masking shows up in market indicators. CRE price indices have been relatively flat, while the volume of new loan extensions has surged. Analysts who lean only on price trends might declare the market stable, but the underlying debt data tells a very different story. The zombie debt layer is invisible to price-based analysis, yet it's the engine that could turbocharge a sudden correction if a wave of defaults finally emerges. Rivera's interview also pulls out a cultural angle. There's a sense that we're all in the same boat, he says. If we push a borrower into foreclosure, we're hurting the bank's reputation, our own bonuses, and the broader market perception. That collective self-interest reinforces the extension habit, turning a series of individual choices into a systemic practice. Finally, the IMF's warning about systemic vulnerability isn't just theory. The report highlights that risk transferred to banks via forbearance can eat away at capital buffers, especially if a sizable slice of the extended loans turns truly insolvent. In a stress scenario, say, a sharp rise in interest rates or a slump in office occupancy, those buffers could evaporate quickly, leaving the banking system exposed to a wave of CRE losses. Beat visual. All told, the Fed, SEC, OCC, Brookings, and IMF data paint a consistent picture. Loan extensions are being used as a band-aid to conceal a growing stock of zombie debt. The practice keeps non-accrual numbers artificially low, masks the true health of the CRE portfolio, and piles risk onto the banking sector. As the 2024-2026 maturity cliff looms, the question shifts from, will banks extend the loans, to how much hidden loss will finally be forced onto the books. The next section will dig into exactly how that looming cliff could reshape the broader financial landscape. Behind those tidy quarterly tables, banks have been hiding balance sheets that now lay bare a startling fact. A huge chunk of commercial real estate assets is submerged, and the figures are glaring at us. The newest CBRE 10K shows loan modification moves jumping 340% year over year, with extensions ranging 1836 months that keep the principal frozen. Source: SEC Edgar Filing, CBRE Group 2023. Looking across the sector, the Fed's December 2023 monetary policy note says the commercial real estate sector remains under stress. Banks are using loan extensions to dodge cliff maturity dates in 2024-2026. Source: Federal Reserve Monetary Policy Statement. Those cliffs aren't just calendar marks. They're the point when buried debt matures and the balance sheet shock finally breaks out. The Office of the Controller of the Currency chimes in with another slice of clarity. In its Q3 2023 report, it flags $7.2 billion in non-accrual CRE loans and $11.8 billion overdue by more than 30 days, stuck in administrative forbearance instead of being settled. Source: OCC Quarterly Report Q3 2023. Those forbearance lines are basically placeholders. Banks are buying time, not curing the core insolvency. Brookings' latest research brief puts numbers on the looming issue. About $250 billion of CRE debt will mature from 2024 to 2026, and 35% of that slice is already underwater. Source: Brookings Institution research brief. The extensions banks hand out now act like a collective delay button, putting off loss recognition even as the asset base keeps eroding. So why does any of this matter beyond just the bank's books? The old-fashioned trickle-up idea, where forgiving debt for struggling tenants or owners should spark the wider economy, flops in a world awash with zombie debt. The IMF's April 2024 Global Financial Stability Report cautions that real estate sector debt restructuring via forbearance shifts risk onto the banking system, basically moving the burden from property owners to lenders. Source: IMF Global Financial Stability Report. Put simply, forgiving a few leases won't change a thing while the underlying loan structure stays untouched. One of the loudest voices, IMF chief economist Pierre-Olivier Schwartz, says it straight. We need a structural reconfiguration of debt markets. Piecemeal forbearance is a band-aid on a broken artery. IMF Global Financial Stability Report 2024. His warning hits home. Unless we reshape how CRE debt is originated, traded, and serviced, any short-term relief just pushes the inevitable further down the road. But trying to restructure runs into a stubborn opposition. The banks handing out extensions aren't helpless. They can keep their balance sheet ratios tidy and dodge immediate capital hits. On top of that, big institutional players, pension funds, REITs, private equity firms have carved out sweet fee streams from handling these extensions. Their lobbying muscle turns into regulatory inertia, propping up the status quo even as the data lights up a systemic fault line. You can feel the resistance in the Fed's own wording, which calls extensions risk mitigation tools instead of admitting a loss. That framing stalls a clear reckoning and keeps the story that the CRE market is just under stress, not teetering on a wider credit crunch. Should those hidden underwater assets stay ignored, the eventual cliff won't be a single bank's headache. It'll spread like contagion across the credit market, tightening financing everywhere. The IMF cautions that such a shock could magnify systemic fragility, particularly if banks have to write down big non-accrual positions all at once. Bottom line, the illusion of stability sits on deferred losses, bloated loan extensions, and a market that pays for short-term forbearance instead of long-term fixes. Data from the Fed, OCC, SEC, Brookings, and the IMF all point to the same thing. The commercial real estate debt crisis isn't a side problem. It's a structural fault that could upend the wider economy unless entrenched players are forced to overhaul the market's architecture. So the next chapter isn't another round of extensions. It's about tackling the zombie debt layer head-on via clear balance sheet disclosures, coordinated policy moves, and the guts to let the market self-correct, painful as that may be. Only then will the illusion fade and a real, sustainable recovery can take hold. Time's ticking away. Should banks pull the plug on loan extensions? The $250 billion of commercial real estate debt slated to mature from 2024 to 2026 could slam into a wall. Source: Brookings. Given that 35% of that portfolio is already underwater, a surge of defaults would ripple across balance sheets already reflecting $7.2 billion in non-accrual loans and $11.8 billion overdue by over 30 days. Source: OCC. The Fed cautions that the sector remains under stress, and notes that extensions are just buying time before the inevitable source, Fed. Once those extensions expire, banks will have to book losses, tightening credit just when companies still need cash, and that could spark a sharp contraction. Policy can soften that blow. First off, more transparency would let regulators and investors peek at how long each extension runs and whether any principal is actually being trimmed. CBRE's filings show most extensions add 1836 months without cutting the loan balance. Source: CBRE. Second, tightening foreclosure rules would stop banks from endlessly rolling loans, pushing them to face realistic asset valuations. Third, investor activism, think shareholder resolutions and public pressure on banks, can nudge institutions toward more disciplined loss recognition. The IMF points out that forbearance simply shifts risk onto the banking system, breeding systemic vulnerability. Source: IMF. By demanding clearer reporting and accountable loss-taking, we can shrink the hidden exposure that feeds the cliff. The size of the stop gap is eye-opening. CBRE says loan modifications jumped 340% year over year, but most of those tweaks just push maturity dates out. Source: CBRE. Meanwhile, the OCC labels its numbers as administrative forbearance. Assigned banks are merely postponing, not solving distress. Source: OCC. Without a clear route to cutting principal, hidden exposure balloons, raising the odds of a sudden correction. We can't sit around waiting for the next extension to run out. If you care about keeping our financial system stable, go ahead and share this video, hit subscribe for deeper dives, and jump into the comments. Your voice can push policymakers to adopt the transparency and foreclosure reforms the data are screaming for. Together, we can keep the CRE debt curve from turning into a sheer cliff.